So we're meeting today as a review session for exam number 1, and we're looking at the exam 1 practice set. So this is out there in Cengage under assignments. You can practice now. It is not graded, it is optional, but it is a good review to get you ready for the exam. So we're going to start with number 1, and we'll just get through as many as we can. Please, if you have a question, stop me, send me a chat, or just feel free to interrupt. So the first one we're looking at is trial balance errors. I need to grab my calculator. For each of the following errors considered individually, so in other words, we don't assume that A is related to B, indicate whether the error would cause the trial balance totals to be unequal. And so we know the only thing that will throw the trial balance off is if we make an entry where the debits and credits are not equal. And anything else can still be wrong, but not show up in the trial balance. The trial balance only shows us if our total debits and credits are the same. So if the error would cause the trial balance totals to be unequal, indicate whether the debit or credit total is higher and by how much. If the debit and credit totals would be equal, enter 0 in the amount box. So the payment of cash for the purchase of office equipment of $15,000 was debited to land to $15,000 and credited to cash for $15,000. So since they are the same, the debit of 15 and credit of 15, it would not show up in the trial balance, but clearly it's wrong because it was office equipment, not land. The reason that's important from an accounting standpoint, as we discussed in class this week, land is not depreciated, but office equipment is. So if we put that in the land account, we're going to be missing some expense as we go forward because we wouldn't be depreciating it. That would overstate our assets and overstate our income in each of those periods where we should be recording that depreciation. Letter B says the payment of $3,000 on account was debited to accounts payable for $300 and credited to cash for $3,000. So the credit to cash is correct, but the debit to accounts payable was low by $2,700. So our credits would end up being higher by $2,700. We credited $3,000, we only debited $300. The difference of $2,700 would be correctly stated on the credit side, but it would make the credits higher in total. Letter C says the receipt of cash on account of $1,200 was recorded as a debit to cash for $2,100. So we have just a typo in there, and a credit to accounts receivable for $1,200. So the accounts that we used were correct. We received cash and we no longer have that receivable, but the debits are overstated. The debits are too high. And the difference between those, $2,100 minus $1,200, would be $900. And so the debit total is higher. So how would we fix that? Ideally, our software would not allow us to put in an entry where the debits and credits are unequal. Unfortunately, some software doesn't have that kind of protection in there. And so the way we would have to fix it is by putting in another entry that had unequal debits and credits. We talked about in class 2 different ways of fixing the errors. One is a one-step process where we just make one entry that corrects all the errors. The other one, which I actually prefer, is the 2-step process where we reverse the entry that's wrong and just remove it, basically cancel it out. Then we put in the correct entry. To me, that's easier to make sure that you're not making a mistake, and it's cleaner to be able to see, oh, that's the entry that was wrong. We canceled it out. We don't delete information from our accounting records. That's a big no-no from an auditing standpoint. So we want to have a very clear paper trail. Say paper, but it can be in the computer. We want to have a very clear trail to say, here's the entry that was wrong. Here's where we fixed it. And the reason for that is because when you make a mistake and then you go back to fix it, if you just delete the old one, you don't know if there are already reports or other types of printouts information out there that has that wrong information on it. And so again, from an audit perspective, there has to be a very clear trail of here's what we had done, it was wrong. Here's where we fixed it. We don't just go back and pretend it never happened. So any questions about that one? Does that make sense? Okay, and I will assume if you don't say anything that, I'm going to make that a little bigger since we have some more room here. So I will assume if you don't say anything that everybody's good. So number 2 says journalize the entry for the purchase of office supplies on February 13th. So this is a basic journal entry to record the purchase of office supplies. So we have some supplies that we did not have before. They have a total value of $4,200. Since supplies is an asset, we want to debit that account to show that we have more of those supplies. It says we paid $345 in cash, so that's like our down payment, if you will. And so we want to show that we used cash to do that. Cash, another asset account, has a normal debit balance. So to show that we used cash, we need to credit cash for $345. And the rest we agreed to pay for later. We paid by, basically we charged it. And so we have to determine how much did we charge. It doesn't tell us that. So if the total bill was $4,200 and we paid $345 down, simple subtraction tells us the balance due is $3,855. Just like to put my green check marks in there, make sure I don't have a math error. So any questions on that? That's a compound entry. We can see that the total dollars debited and credited, if we add these two together, those are equal. And so this is a good journal entry in that it has all the required parts. It has the date, at least one debited account. The debited accounts are always listed first, followed by any credited accounts. The credited accounts are indented. The software does that for us as soon as we start entering a number in the credit box, something that I just think is really cool, very helpful. But if you were writing this on a paper form, for example, you would want to make sure you indented, just because that's the proper form. Remember in the reference materials in Brightspace, there is a little snip from a textbook that shows all of the required elements for a journal entry. So being able to write a journal entry is very important.
I have a quick question, Cindy.
Yeah, yep.
So when you talk about the debited accounts are listed first,
Right.
Talking about the accounts that have that normal balance, like that the debit is the normal balance.
It doesn't mean accounts that have a normal debit balance. It means the action that you're taking. So the dollar amount is going to be recorded in the debit column. So for example, accounts payable has a normal credit balance, but if we were paying off an account payable, we would be debiting that account to reduce that balance. And so that would be listed first. So if you're going to put the number in the debit column, that account needs to be listed at the beginning.
Okay.
Does that make sense?
Yes, thank you.
Mm-hmm. And say by the same token, cash is an asset. It has a normal debit balance, but because we're crediting it, because we're using cash in this circumstance, it has to be listed after the debited accounts. So good question. I hadn't really thought about it like that, but that could be, I get why that's a question.
Thank you.
So our next exercise comes from chapter 3. Remember, you can always see in the numbering of the exercises which chapter it came from. So this came from chapter 3. This one comes from chapter 2. So as you're working on the exam or any other combined assignment like this, if you are needing to look something up, you want to check something in the textbook, that's going to give you a pointer of where to start looking for that by which exercise or which chapter does this exercise come from. So this one says adjustment for accrued revenues. At the end of the current year, $15,180 of fees have been earned, but have not been billed to clients. And you might be asking, why wouldn't we just bill them? Well, maybe we have an agreement with the clients that we only bill them the 15th of the month, or maybe we bill them quarterly, the month after the quarter ends. So if our year is ending at the end of December, we might have agreement with clients that will bill them on January 15th or January 31st. Remember, in that 4-step test to know if we've earned the revenues, there's nothing about cash changing hands. We don't have to be paid. In fact, when we get to the chapter on receivables, we'll talk about how sometimes you might never get paid. You allow a person to buy on credit. Maybe they are unwilling or unable to pay the bill when it comes due, and that can happen. That doesn't mean we don't earn the revenues. So the step to know if we've earned the revenues, we have to have an agreement between the buyer and the seller. We have to have a price that's fixed or determinable. In other words, we need to know the dollar amount. We need to have performed the service or delivered the product. And we have to have reasonable assurance of collectability. So as long as all 4 of those things are in place, as soon as the final one of those 4 is in place, then we have earned those revenues, and the matching principle says we need to record them in that period. Even if, like I just described, we have an agreement with the customers potentially that says, you're not going to bill us till next month. And so that's what's happened here. It says we've earned them. And so we can be assured that we've met all 4 of those steps, and we now have a right and really an obligation to record those revenues. And so fees earned is the account title that represents the revenues for this company. And we are going to accrue those revenues at the end of the period. So we know, we talked about this week in class that accruals, adjusting entries, which is an accrual, is a type of adjusting entry. Adjusting entries have all the same rules as a regular journal entry, but they have one additional guidance, which is there's always going to be one income statement and one balance sheet account as we adjust those financial statements. So this is the income statement account. It's the revenues that we've earned. So we know the other one is going to be a balance sheet account. And because I don't see another one that would work better, I'm going to use accounts receivable, because that represents that our customers owe us. I don't really like that account title, and we'll talk about in chapter 8 on receivables. We'll talk a little bit more about why I personally think it should be a different account title. But for now, I'll just say, once we put it in our receivable, we start tracking that for when it's due. When should our customers have paid us, so that we're keeping track of, should we be sending a message, sending a note? Should we be thinking about sending this account to collections? And so if we have an agreement that says we won't bill them yet, we shouldn't be putting it in accounts receivable. It should be some other kind of account, like revenue receivable or something like that. I'm not really sure what I would call it, but I wouldn't call it accounts receivable unless we actually just sent them the bills. And if we sent them the bills, it's not an adjustment. It's just a recognition that, oh, wait, we need to mail those bills. And so we contact the receivables office, the billing department, and say, hey, send out those bills. And then it's not an adjustment, it's an actual transaction. So I threw in a lot of extra information there, just things to think about. Everybody okay with that one? Okay. Our next exercise is another adjustment. So this is also from chapter 3. And it says that we pay salaries on Monday for a 6-day work week that ended the previous Saturday. So I'm just going to do some quick math here. So if our employees are earning, I don't know why that's in red, change that color. So if our employees are earning $18,875 a week, and that's for 6 days, then how much is the earnings per? Okay, well, that's not helpful because it doesn't come out neatly. It says round to the nearest whole dollar. So that would be $3,145, no, sorry, $46 per day rounded. I'm going to suggest that the reason it doesn't work out to a whole dollar is because these are generated algorithmically, some of them, so they probably just stuck a random number in there. Hopefully it doesn't throw us off because of rounding. So it tells us that we want to, the period, the month, the quarter, the year, whatever, ended on the previous Friday. And so the employees would have earned 5 of the 6 days worth of salary. And those salaries, even though we're not going to pay them until the next Monday, we need to make sure that the salaries for Monday through Friday get into the correct period. Again, it's the matching principle that tells us that we need to record revenues when we've earned them and then match against them the correct expenses. So hopefully I avoided rounding. I just multiplied the actual number by 5, and the amount that I got for the salary expense that belongs in the previous period is $15,729. So what are we recording? We're making sure we get the salaries expense in the previous period for that Monday through Friday. Saturday will go into the next month or the next period, and the cash flow for the whole almost $19,000 will also happen in the next period. So remember, adjusting entries never affect cash. We know we need an income statement and a balance sheet account. So salaries expense is on the income statement, and we need a related account on the balance sheet. And that, of course, would be salaries payable. We want to make sure that our liabilities reflect that we owe our employees the $15,729. So that's really the point of adjustments, is to make sure that we're meeting our obligation in that matching principle, that our income statement in any given period, month, quarter, year, whatever the accounting period is, accurately reflects the revenues we earned in that period based on that 4-step test, and then the expenses that go with those revenues. So the fact that our employees worked for 5 days during that previous period, we need to make sure we get the expense in that previous period. Again, even though we don't pay them until Monday, we need the cost or the expense in the previous month. Okay, next we have an adjustment for unearned revenue. On June 1st of 2022, Monarch Company received $50,410 for the rent of land for 12 months. In other words, our tenant paid us upfront for the entire year. But then we get to the end, and so let me just put a couple T accounts up here on the screen so we can think about what's happening. So I'll put them down here. So when we receive that payment, and I apologize, I'm trying to be quick, and so these are not very neat. Trade-off between being tidy, whoops, and being fast. So at the time that our tenant paid us, we haven't yet allowed them to use the property for the 12 months. And so based on the 4-step SEC test, we haven't actually earned any of that payment yet. So at the time they pay us, we of course have to record that we received the cash, because every time cash changes hands, it's by definition a transaction. We need to show that we received that cash, but we can't show, should not, whoops, wrong keys there. We should not show that we've earned any of that revenue, because we now have an obligation to allow our tenant to use the land for the next 12 months. And so that's the first entry, to record the receipt of that cash. And now we have this whole $50,000 sitting on our balance sheet as a liability. We owe our tenant the right to use that land. We now get to the end of December, and they've used the land. They've had the use of the land for June, July, August, September, October, November, December. That's 7 months out of the 12 months that they leased it. So if we want to look at it like this, the $50,410 is for 12 months. So I just want to know how much is that per month. So it works out to be, again, it doesn't work out neatly. We're going to have to round, but it works out to be about $4,201 per month. And they've had the use of this land for 7 months. So if I multiply that by 7, it comes out to, at the end of the year, again, rounding to the nearest dollar, we have now earned $29,406 of that initial payment. So the adjustment is going to be to, since we no longer owe this $29,000 worth of land use, we need to get that off our balance sheet. It's no longer a liability for us. So the entry will be a debit to the unearned revenue account, because that's no longer a liability for us. And the credit, again, this is an adjusting entry, so it has to include one balance sheet, one income statement account. Clearly, there's a connection between this unearned revenue liability on the balance sheet and the earned revenue on the income statement. So if we wanted to take this one step further and just see, well, how much do we still owe our tenants then? $50,410 was the original balance, and we've now earned $29,406. So the ending balance, what would show up on our year-end balance sheet, would be, we still owe them $21,004 worth of rent, of use of our land. So to answer the question, what we, the entry we need to make, the change we need to make to these accounts is to move $29,406 off the liability of unearned rent, is what they called it. I just called it unearned revenue, and onto the income statement as earned revenue. We've held up our part of the deal. We let them use our land for the whole, the last 7 months. And now next year, we will earn the other 5 months, or $21,000 worth of that revenue. Make sense? Okay. Another type of adjusting entry that many businesses have, and definitely one that we covered in Chapter 3, prepaid insurance. Prepaid insurance account had a beginning balance of, and I'm going to put my T account up here on the screen so we can keep track of what's going on here. So prepaid insurance. Prepaid insurance is an asset. It's a current asset, using the terminology we talked about this week in Chapter 4. So this is something that is going to be used up or turned into cash within 1 year. It's an asset, so it has a normal debit balance. It didn't tell me the balance was a debit balance here, but we can assume that it has the normal balance for that type of account. So since it's an asset, it has a normal debit balance. We start with that balance on the debit or the left-hand side. And then during the year, we bought some additional insurance, and that insurance had a value of $1,330. And so at that point, the total balance in our prepaid insurance would be $4,500, $4,500 worth of insurance. Now, in case you're wondering, the debit here of $1,330 would match against a credit to cash. It says we paid for some additional premiums, so we would have used cash or credited cash for the other side of this entry. You can't have just a debit without a credit. So I'm only showing the debit because we're really right now for this exercise only concerned about what's happening in the prepaid insurance account. So we know at the end of the year, we have a $4,500 balance. And when we get to that adjustment period, we look at that and say, yeah, but do we really have $4,500 worth of insurance left? And we do an analysis of, well, what was in there, and it tells us the amount of unexpired insurance is $1,670. And so what that means is, and I'm just putting these in here so I can balance this account. What that means is that we know that the ending balance in this account ought to be $1,670, because that is the value of insurance that hasn't yet expired, that we still have left. So from what I've already said, we have $4,500 in there right now, but we know it should only be $1,670. So if we have too much in there, too much in that account, we know we're going to need to credit this account to bring it down to the correct balance that we've identified. And so how much do we need to credit? The difference between these two numbers, the current balance of $4,500 and the target ending balance of $1,670, we need to credit this account for $2,830. And that will be our adjusting entry, $2,830. So we no longer have that insurance. What happened to it? It expired. It benefited us in the previous period, the period that just ended. It benefited us in the previous period. And so we need to show the expense, the cost related to that on the previous period income statement. So again, we have that kind of matched pair of accounts, insurance expense on the income statement, prepaid insurance on the balance sheet. We reduce the value of our asset, prepaid insurance, and we increase the expense on our income statement for that same period. I strongly encourage you to use T accounts in the same way that I'm using them here, kind of as a scratch pad or notation, to kind of just keep track of what's happening. I think it's much easier to see it when I can actually visualize the T account, as opposed to trying to maybe just think it through without writing it down. If you find that useful, I would encourage you to use that. Everybody good? So for this exercise, adjustment for depreciation, I'm not going to go through the whole explanation of what depreciation is. I did do that in class this week, so I would recommend that if you need to hear that you go to the video from the end of chapter 3, the conclusion of chapter 3, where I go through the entire rationale and explanation of what depreciation is. For this exercise, we're just asked to do the entry for depreciation. And so I'll remind you that the depreciation entry always includes a debit to depreciation expense and a credit to that new type of account that we learned about this week called a contra asset. Accumulated depreciation goes against or nets against the asset, equipment in this case. So the equipment account is going to show the historical or original cost, the upfront cost to acquire that equipment. And then the entire time we're using it, because of the matching principle, we need to make sure we're reporting the expense or the cost of the upfront cost of that equipment that benefited us in this period. I explained to you on Tuesday of this week in the conclusion to chapter 3 how one way of calculating depreciation called the straight line method. And really that was just to explain where this $33,200 might have come from, or how that might be calculated. When we get to chapter 9 in several more weeks, when we get to chapter 9, we'll come back to that concept and see actually 3 different ways of calculating the depreciation amount. For all 3 of them, though, the whole point is to figure out what benefit are we getting from this long-term asset? How do we take the upfront cost and divide it up over the useful life? So 3 different ways of doing that we will learn in chapter 9. And all 3 of them end up recording the same amount in total. The difference is how do we divide it up across the useful life, whether it's a 5-year, 10-year, or 30-year useful life. How do we take that upfront cost and match it to the periods that we're benefiting from using that asset? Okay, so again, for this chapter, for this exam, you don't need to know how to calculate depreciation. That number would be given to you, so you would only need to know how to do the entry. Will always be a debit to the depreciation expense and a credit to the accumulated depreciation for that particular asset class. Okay, stop me if you have questions. Our next exercise is a balance sheet. And I know in class this week, we looked at a classified balance sheet, but this is still chapter 3 or 1 or 2. This is still the simple balance sheet. So we know that the balance sheet is really the permanent accounts from the fundamental accounting equation. Assets equals liabilities plus stockholders' equity. So we know when we get to the end of this, we're going to have a way of checking ourselves. The total assets that are going to appear right here need to match the total liabilities and equity here. We're given a series of account balances, and it's possible that some of these may not even belong on the balance sheet. So we need to go through them one at a time, identify which ones belong on the balance sheet, and put them in the appropriate place on the balance sheet. Looking at these, starting with fees earned, well, we know fees earned is a revenue account. Revenues don't belong on the balance sheet, so I'm just going to ignore that line altogether. The next line says office expense. We actually have several different expenses here: office expense, miscellaneous expense, wages expense. Those are income statement accounts. Again, don't belong on the balance sheet, so we're going to ignore those. Doesn't mean they're not relevant for this company, certainly, but it is not something that we need to construct this balance sheet. So looking now, we have accounts payable, accounts receivable, cash, common stock, land, and supplies. All of those are balance sheet accounts, permanent or real accounts. They carry their balance forward. We know that the assets need to be listed in order of liquidity. So thinking about the assets that we have on here: cash, accounts receivable, and supplies. Cash is always going to be the first. We have accounts receivable and supplies. Did I miss another one? Oh, land. Yeah, then there's land. Land is also an asset. Of course, land would be the longest term asset that we have. Cash, accounts receivable, and supplies, using what we know from chapter 4. Sorry about that. Using what we know from chapter 4, those are all current assets. And now normally our templates give us a little bit of a hint about which order. Looking at accounts receivable and supplies, I would probably put accounts receivable first because it's more of a financial asset. I would probably put that higher than supplies, but that's not immediately obvious. But you'll notice that the template didn't give us an option of putting supplies second. So it does give us a bit of guidance to get those in the correct order. And so if we total those, see if I did this right, 508, 215 is our total of the assets. So because we know that this is an equation, assets equals liabilities plus equity, we can go ahead and put that number down here for total liabilities and equity as well. We have a way of checking ourselves or filling in the blanks for something we don't know. To keep going then, we had just one liability, accounts payable. So since there's only one, we do not need to have a separate line that says total liabilities. That would just be, fluff. It would just be extra information that doesn't give us any more useful, decision-making power, if you will. So because there's just one liability, I'm just listing that one and not providing a total. Of course, for a real company, they would always have more than one liability. And so you'd have them listed and then a total for the liabilities. We know until chapter 12, our stockholders equity section is always going to include these two accounts, common stock and retained earnings. And the common stock account has a balance of $135,000. You'll notice what it tells us about retained earnings. This is the beginning balance from last year. So we could go through an exercise to determine the ending balance by taking into account these four accounts right here. Revenues of $708,885 minus those three expenses. Oops. And when I take the revenues and subtract the expenses, I got net income, because our revenues were higher than our expenses, net income of $191,395. Okay, so that's one way to approach this. If we know that whoops, I just closed my, there we go. So we could start with our beginning balance and retained earnings, which was 191. We can add to that our net income, and then we can subtract the dividends, which we're told were 26,900. And that should allow us to find our ending balance. So we start with the beginning balance. This is what would happen on the statement of stockholders' equity. We start with the beginning balance. We add to it our net income. If it was a net loss, we would subtract it, of course. And then we subtract the dividends to get our ending balance. So if I've done my math right, the ending balance in retained earnings should be $355,495. Add to that our common stock, and that makes our total stockholders' equity $490,495. And if I add to that our liabilities, $508,215. So that's kind of the long way to get to the answer here. It worked, but it was a little bit of extra work that we wouldn't really need to do, because we already knew the total liabilities and equity was $508,215. How did we know that? Because it has to match the total assets. So if we took that number and subtracted the liabilities, we would know how much must be the balance in stockholders' equity. And then if we subtracted the common stock from that, we would have gotten what the retained earnings balance must be at the end. So that would have been a little faster for us. but it's not the realistic way that this happens. Again, what I have here, what I've written here on the screen, is what would happen on the statement of stockholders' equity. We start with the beginning balance, we add to it net income or subtract a net loss, we subtract the dividends, and that's how we get the ending balance. So everybody okay with that one? So either way would have worked. If they hadn't given us this information about the income statement accounts, or if they hadn't told us directly what our income was, we would have had to just back into it. And I know we've had to do that in at least 1 or 2 exercises. Okay, we're doing okay for time. So let's move on to exercise 9. The income statement. So this is what's known as a simple income statement. In chapter 5, we're going to make this what's called a multi-step income statement, just like we did in chapter 4 for the balance sheet, where we kind of divided things up and put in some subcategories: current assets, property, plant, and equipment, current liabilities, and long-term liabilities. We're going to do this in chapter 5, the same thing, add an extra step to the income statement. It doesn't change what's there. It just gives you a little bit more detail. So for now, though, for this exam, we're still looking at what's called the simple income statement, where we list our revenues, we list and total our expenses, and then we subtract to find our net income or net loss. So this is pretty straightforward. While I'm filling in the account titles from what I see up above, I will mention the 3-line heading that's on all financial statements: name of the company, name of the financial statement, and then the date or range of dates. So a balance sheet just has a date. The income statement, the statement of stockholders' equity, and the statement of cash flows all cover a range of dates. And so it would specify, is this for the day, the week, the month, the year, the quarter, whatever. As far as ordering of our expenses, again, the template's going to be helpful for that. But the general rule is we want to start with the largest numbers. So we have 3 expenses here: wages, office, and miscellaneous. Miscellaneous always goes last, even if it's not the smallest number. And the reason is because that is going to be an accumulation or a aggregating, adding together a bunch of different types of expenses that are all relatively small. For the other expenses, though, miscellaneous goes last. For the other expenses, the general rule, certainly what the software wants us to do, is to list them from smallest to largest. I said that totally backward. List them from largest to smallest. I apologize. So we have our revenues. There's only one account, so we put it over in the far right column. I should point out that on a financial statement, we don't use debits and credits. So this is not a debit column. This is not a credit column. Okay. There are no debits and credits on financial statements. So the reports that we share with the public do not have debits and credits. It's just a kind of a nice way of lining this up so that the right-hand column has the totals. Those are the big numbers, the key numbers we want to focus on. And then whatever's in the left-hand column will be the detail. When you look at a real company, like the company that you've chosen for your project, when you look at their financial statements, you'll see that they have at least 2 years worth of data side by side, and many companies choose to report more than 2. So GAAP requires at least 2 years, and some companies will have 3, 4, or even 5 years worth of data. And so what you'll see is they don't spread things out like this in 2 separate columns. They'll have all the numbers from 1 year are just in 1 column. Because imagine how big, how wide that financial statement would get if we have 3 years worth of data and each year has numbers in 2 or 3 different columns. It would just be too unwieldy. And so our general rule again is when we're doing this to make it nice and pretty with just 1 year, we might use a left and a right column, or sometimes even 3 columns to kind of separate things out to make it look prettier, but that's not a necessity. And certainly if we were doing more than 1 year, we would likely not do that at all. So now I'm just subtracting the total expenses from the total revenues. Should also point out that some companies, frequently in the real world, companies have more than one source of revenue. And so there could be multiple revenue lines, and then we have a total revenue. Because the total revenues are higher than the total expenses, we have a net income for the bottom line. Okay, any questions about the simple income statement? So it's very reasonable to assume that on the exam, you will be asked to produce a balance sheet, which we just did, an income statement, which we just did here, and also a statement of stockholders' equity. And so I don't have an example of one of those here in the practice set, but we have done several of them in the exercises throughout the chapters. And so I would encourage you to make sure you review those as well. Basic format for a statement of stockholders' equity. We start with the beginning balances for common stock, for retained earnings. To the common stock, we would add any additional sales of stock during that period. And for retained earnings, we're going to add the income or subtract the loss and subtract any dividends that were paid. So the bottom line is the ending balances, and those ending balances then flow into the balance sheet. Our last exercise, as we're getting up to the time here, is related to the accounting equation. And so we learned in chapter 1 the fundamental accounting equation that is really the underpinning of everything else that we do. And so here's our fundamental accounting equation. It tells us Inspiring You is a motivational consulting business. At the end of its accounting period, December 31st, 2022, Inspiring You has assets of $583,000 and liabilities of $140,000. It wants us to determine the stockholders' equity. And so there's our missing piece. So how do we find that stockholders' equity? We're simply solving this like any other math equation. We're going to subtract $140,000 from each side to get the missing piece, the variable, by itself. And so we have stockholders' equity of $443,000. It's kind of funny that there's $2 signs here in front of that. That's obviously a typo. So we started the year with $443,000 in equity. And then it tells us that during the year, assets increased by, whoops, I don't need that dollar sign, 111,000. And then it tells us that liabilities decreased by 34,000. So what do we have at the end of the year? So if our assets went up from 583, it went up by 111, our assets at the end of that year would be 694,000. And if our liabilities were 140 and they went down by 34, that would leave us with 106,000 in liabilities. And so now we just need to solve for that one more missing piece. 694 minus 106 would be 588,000. Okay. We made it. It's 10:30. We are out of time. Before I pause the recording, does anyone have a question? Okay, I'm going to stop the recording.